On Thursday, 6th of November, Professor Niall Ferguson gave a lecture at the LSE on his new book, The Ascent of Money.
I'd like to thank Arne for inviting me to do this. He has made one of the great contributions to the historiography of the Cold War. In many ways, the best book on this subject published in 20 years. And so it's an honour to be here sharing a platform with him. What I want to do this evening is to sketch the argument of my new book, The Ascent of Money, and then to invite you to ask questions about it. And I will, in fact, address Arne's question about the title towards the end of what I have to say. One of the propositions I make in the book is that behind all history's great events, there is a financial backstory. And I want to illustrate the point with the most recent great event in history, the election of Barack Obama. Now, I don't suppose many of you on Tuesday night were thinking much about finance. I know I wasn't. It was impossible not to be caught up in the extraordinary euphoric mood of that night. It was impossible not to be moved, and I was deeply moved by the sight of Barack Obama accepting the presidency of the United States. But we must ask ourselves, as historians, a question. Would he have won that election had it not been for the devastating impact of the credit crunch? A financial crisis which began in August of 2007, but which really began to affect the mentality of ordinary Americans and affect that mentality with a vengeance in the last 2 months of the presidential election campaign, culminating in October of this year with one of the biggest financial panics we have seen since the Great Depression. Let's ask ourselves how things would have looked if it had not been so. There is actually quite a nice correlation between the collapse of support for John McCain and the decline of the US stock market, illustrated here with the Standard & Poor's 500 index. I throw out the hypothesis that if this had not happened, if it had not become an election about the economy, it would have been a much closer race. And indeed, when you consider the relatively small margin of victory in the popular vote, I say relatively small, because considering all the mistakes that have been made by the Bush administration, it should really have been in double digits. It's worth pondering just how Tuesday night would have turned out in the absence of a financial crisis. In short, this historical event has a financial backstory, and those who try to tell the story of Barack Obama's apotheosis without discussing the credit crunch will be missing a key element. Who's controlling these slides? Is it me or you? Here's the deal. I'll make them go forward, and if I say, can we go back, you make them go back. The contrast that I draw, always beware of new auditoriums. The contrast that I draw in the book is between two planets. Planet Earth, which you're familiar with from the Mercator projection, and Planet Finance. You're going to have to do it. I'm going to point this at you. So just watch me. This is how Planet Finance looks if you're in Manhattan. It's how the world looks from that island. But Planet Finance has many guises. Here's another one. This is how the world looks if you scale countries according to their gross domestic product and shade them according to per capita income. It's a very different world from the Mercator projection. You'll notice, wait for it, because I'm really going to point it at you. Not yet. That was an illustration. Thank you. If you look at Planet Finance by numbers, this is how it looks. You'll see if you just look down at the chart that I have a figure for the gross domestic product of the world. These are all figures from 2006. And you'll see that world GDP in 2006 was slightly short of $50 trillion. That's according to the International Monetary Fund. The funds under management by hedge funds, you'll see there, was something like $1.5 trillion. Sovereign wealth funds controlled slightly more, sovereign pension funds slightly more than that. The World Central Bank reserves amounted to something like $5 trillion. International bonds and notes upwards of $17 trillion. International assets of banks, not far off $30 trillion. It's actually miraculous that I can read these figures without my glasses on. I'm deeply impressed. But what's really striking is when you get up above world GDP, which is just there as an order of magnitude, nobody needs to point out to me that that's a flow and the rest are stocks. I also know that. The critical point is that you've got, in the bond market, domestic debt securities in excess of world output, stock market capitalization in excess of world output, and exchange-traded derivatives significantly in excess of world output. But then, let's look at the value outstanding of non-exchange traded derivatives, over-the-counter derivatives. At the end of 2006, according to the Bank for International Settlements, those amounted to more than $400 trillion. The point I wanted to make, that's almost an order of magnitude larger than the entire annual output of the world economy. The point I wanted to make is that in our time, planet finance has grown to the point that it dwarfs planet Earth. And that is, in a sense, what the ascent of money is about. This relative growth of the financial sector, which has been an extraordinary phenomenon of the last 80 years, which has meant that a rising proportion of graduates, certainly from Harvard, no doubt from the London School of Economics, have been drawn in to the financial services sector. When I talk about the ascent of money, I'm talking in large measure about that. And then the descent. We're living through an extraordinary time of financial crisis. By many measures, the most serious financial crisis since the 1930s. It's probably not since 1973-74 that the international financial system has suffered a shock like the one it has suffered in the last 14 or 15 months. And here's one measure of it. This tells you how world stock markets have performed in the year to date. As you'll see, some markets are down by as much as 2/3, close to 70%. I pity you if you invested in the Belgian stock market in January of this year, because you have had a Great Depression-like wipeout. Notice, by the way, in this chart, the poor performance of the so-called BRICS. Some of you will have heard of the BRICS. Brazil, Russia, India, China, dubbed the BRICS by Goldman Sachs in a famous report of a few years ago. The BRICS were going to inherit the Earth, you may recall. Big, rapidly industrializing countries. It's good that they called them BRICS because they're dropping like bricks, down around 2/3 year on year. If you went for the BRICS bet at the beginning of this year, you must be cursing Goldman. If you'd stuck with the good old United States, you'd only be down about 1/3. What caused this crisis? What caused planet finance to come crashing back down to Earth? That is the reason that I wrote this book. Let me tell you a story about Mary Poppins. 2 years ago, almost to the day, I was in the Bahamas. I had been invited to give what is known as a keynote address to a conference organized by an investment bank. You remember what investment banks were, don't you? At this conference, attended by principally the hedge fund clients of this investment bank, I stood up and I said that a major liquidity crisis was imminent, that this would come as a tremendous shock to the financial system because financial institutions were so highly geared, had accumulated such large amounts of debt. When the liquidity crisis struck, they wouldn't be able to roll this debt over and it would be ugly. And I threw out a comparison with the crisis of 1914, when a geopolitical shock, the outbreak of the First World War, caused a total seizure of the international financial system that led to the major stock markets of the world literally having to close their doors for a period of months. The London Stock Exchange didn't open its doors again until January 1915. Banks were plunged into near insolvency throughout the City of London, and only a series of emergency measures by government, including the injection of liquidity, bailouts, and even moratoriums on particular kinds of debt, prevented a total meltdown. Actually, 1914 was a bigger financial crisis than 1929 to 32, but it was suppressed by massive government intervention. And this could happen, I said. In fact, this will happen. Well, I'm not sure that I got a very receptive audience that day. There was a kind of weary sighing as I made my gloomy Cassandra-like prophecy. And afterwards, one of the conference participants suggested to the organisers that next year, rather than invite a dreary, pessimistic academic again, they simply show the film Mary Poppins. Now, I was rather hurt by that, because I do have feelings. I had to go for a run to calm down. As I was running up a hill, it suddenly struck me, Mary Poppins. Mary Poppins. And I remembered that scene. Perhaps you do too. There must be some Julie Andrews fans here. It's when she takes Michael, the son of Mr. Banks, to visit the bank where Mr. Banks works. And they try to persuade Michael to deposit his tuppence halfpenny pocket money in the bank. And he says he doesn't want to. He wants to use it to feed the pigeons. Give me my money back, he says. And another client of the bank standing in the bank office hears this and says, did you hear that? They won't give that boy his money back. I think I want my money back. Could I have my money back, please? And another client says, did you hear that? They're not giving people their money back. I'd like my money back, please. And I want mine too. Stop all payments. The bank has to suspend payments. It goes bust. Mr. Banks loses his job. It's a bank run. You can imagine the feeling I had when I remembered that scene. I ran back down the hill to my laptop and I sent an email saying, what an extremely good idea. Next year you really, really must show Mary Poppins. Don't invite me, just show the movie. You know the saddest words in the English language? Too late. Because by November 2007, a year later, it had already happened. Northern Rock, bank run. Hadn't been one in London since 1866. What caused the crisis? I would suggest to you a lack of knowledge of financial history has been one of the prime causes of this crisis. And the purpose of the Ascent of Money was very simple. I wanted to write a book that would give you a one-stop shop for the financial history of the world, on the principle that that was what was missing. Financial history, is a very poor relation in the academic world. Very few universities offer courses in financial history, also few business schools. It was regarded as a great innovation when I was invited to New York University to lecture in financial history. When I created a course in financial history at Harvard a couple of years ago, the department administrator said, well, you won't need many teaching fellows for that, because I don't suppose more than about 8 undergraduates will take it. Well, in fact, 122 took the course, which caused all kinds of chaos. I think there's an appetite for financial history among students, but there is not much provision of it. And one consequence is that throughout the financial system, not only at the top, not only in Wall Street and the city, but right down at the grassroots, among the ordinary people making decisions about their mortgages and about the allocation of their assets, there is a breathtaking ignorance of financial history. And most people rely, therefore, on their own experience, which isn't enough. It is not enough. The average chief executive's career in charge of an investment bank was 25 years when I worked it out a year ago, which meant that nobody remembered much before 1982, when the crisis began. And if they were only relying on the history of Wall Street or the city since 1982, they were bound to underestimate the risk of a liquidity crisis because they'd never been through one. And one of the key points I try to make in the book is that major financial crises happen, they do happen quite often, but not often enough for people to remember the last one. And that's why you have to study financial history. Let me tell you how the book works, and also how the television series works, for those of you who can't read. The idea is very simple. It's to give an overview of the structure of the financial system. So it's in some measure thematically organized. There are 6 chapters or films. One deals with money, the second and banking. The second deals with the bond market, the third with the stock market, the fourth with insurance, the fifth with the property market, and the sixth with the globalization of finance. And the idea is to tell this as a story because it has a roughly chronological narrative to it, and to explain where it all came from. Because I have this very simple historian's view of things. I don't really understand anything until I know where it came from, where it originated, where it came from, what its story is. You can draw flowcharts on the board, you can tell me any number of equations, I won't get it until you tell me, why did they invent central banks, please? What was the first money? That's the first money. It's a clay tablet from the British Museum. It's about 4,000 years old. One of the exciting things about filming the series was being able to hold one of these. They're quite surprisingly robust, which I suppose isn't so surprising since they've lasted this long. And I argue, not an entirely conventional view, not all ancient financial historians would agree with me, that this is money. It's money because what it says on that is that X promises to pay the bearer of the clay tablet a particular amount of a commodity, usually wheat, on a specific day. And it's that promise to pay the bearer that is the key. If you pull out a banknote, you'll find a promise to pay the bearer on demand on most British banknotes. Money, I suggest in the book, it's not precious metal, which for many years people thought it was. Money is just a relationship that gets formalized between a debtor and a creditor. And money is a necessary part of civilization because without money, it's impossible to construct complex relationships in space and time between debtors and creditors. In any agricultural society, it's a problem. You need the money now, but you're a farmer, you just planted the seed, you're not going to be able to deliver the wheat for at least 3, 4, 5 months. And so the original financial transaction is about cash in advance of the harvest. And that's what money allows you to do. It allows you to make transactions in space and in time that you simply can't do in a pre-money barter system. Now, what I want to try and do this evening is to show not only the origin of things, but to try to explain a little bit what went wrong in the recent past. The aim of the book and of my lecture this evening is to relate recent events to the deep past in the hope that we could better understand them. Money evolved, and evolution is a key word in my story. It evolved into coins by the standards of ancient Babylon quite recently. It was only a few hundred years before the birth of Christ that coins, as we understand them today, came into existence. And these coins performed a particular function. They, in general terms, allowed states to monopolize and exploit the production of money. That's why coins generally bore the head of a sovereign. They were an assertion of the state's monopoly power to issue money, and of course to exploit that power, usually by debasing the coinage, the content of the coinage in some way. To understand money as precious metal, printed, minted, I took an extraordinary trip to Bolivia because I wanted to see the rich hill. And there it is, at Potosi, which for 2 centuries was the principal source of silver of the Spanish Empire. Potosi was one of the great centers of the late 16th and 17th century world. A huge Hispanic city sprang up there, despite the fact that it is at an extraordinarily high altitude. You feel quite awful the whole time you're there. And this mountain was practically solid silver ore. When the Spaniards discovered it, they thought they'd struck it rich, because they thought money was equivalent to precious metal. The more you had of it, the richer you were. The tragedy of the Spanish Empire was that this was a fatal misconception. All that happened as they extracted the silver from the mine, or rather as enslaved indigenous peoples extracted the silver from the mine at huge loss of life, all they did was to generate the first inflation of early modern history. Ever more coins were sent across the Atlantic from the mint at Potosi to finance Spain's wars. And the quantity theory of money was suddenly revealed. What the Spaniards had done was not to become richer by discovering Potosi. All they did was to raise the European price level by generating a substantial monetary expansion. So money never was precious metal. It always has been about relationships and about trust. Trust in the value of the coinage, trust in its purchasing power, was eroded by the Great Inflation, a phenomenon that was made worse by the habit of European governments of clipping or otherwise diluting the precious metal content of the coinage. I tell the story in the first film of how the institution of the bank arose, illustrating the story with the case of the Medici. Everybody knows about the Medici as patrons of the arts and indeed as political figures in the history of the Renaissance. But remarkably little is actually written about how they made their money. So I wanted to write about the bank, to understand what it was that allowed these people to make money lending respectable. The answer is quite simple: economies of scale. The loan shark, the small money lender, the Shylock figure, had no chance of attaining respectability because of the small scale of the operation. If you're a loan shark, you're operating on such a small scale that you, by definition, have to charge usuriously high interest rates and be nasty to your debtors. The Medici illustrate the point that with banks you gain economies of scale. The more creditors and debtors there are on your balance sheet, the lower the risk you run in taking deposits and making loans. All the bank really is, at least in its original form, is something that intermediates between debtors and creditors and exploits efficiencies of information, matches up the people who need the money with the people who have the money. And the Medici illustrate this point quite neatly. And they also illustrate the point that once you've made money as a banker, you can buy yourself a whole lot of respectability and a whole lot of power. Surely nothing illustrates it better than the way the Medici had themselves painted as if they had been present at the birth of Christ. There are at least 4 members of the family in this picture, including the leading wise man. So, how do we get from the Medici to Nightmare on Wall Street, to Lehman Brothers and its failure? That's really one of the key questions you have to ask yourself. And a very simple answer that I'm going to offer this evening, the complex answer is in the book, but the simple answer is that it has to do with the breakdown of trust. Most money in our time, and this has been true for quite some long period, is not banknotes. It's certainly not coins. Most money is bank accounts, bank deposits, current accounts in particular. And the different measures of money that you may remember from the dim and distant days of monetarism, M1, M2, M3, just capture the maturity of the different kinds of bank deposit, those that are in deposit for a particular period of time, as opposed to current accounts that you can instantly access. Most money is in banks. You can't see it, and that's because it's not really there. It's not really there because it's been lent out. And bank runs happen when all the depositors want their money at once. And they can't have it. Fractional reserve banking was one of the great inventions of the 17th and 18th century. The discovery that you could collect deposits, but you didn't have to just keep them all there in case everybody showed up and wanted it back. You could lend most of it out and just keep a reserve there. Because in a typical year, only a small fraction of your depositors would need the money. It's a simple idea, but it's genius. Once you've got fractional reserve banking, you can start to create credit as never before, and that's what banks did. Creation of credit. The growth of money as bank money is one of the keys to the development of Western civilization. Banal though it may sound. I know it's not up there with Newton, but frankly, it's just about as important in practical terms. So most money is in banks, except it's not really in banks. You just hope it's there when you need it. And most of the time, it is, right? Most of the time. Talking of the ascent of money, there's its recent ascent. That just tells you a simple story, the growth of the narrow money stock, money of zero maturity, which is essentially M2 minus time deposits, if you're technically minded. And that's a story of the US money supply since 1990. The overwhelming part of money in America, as here, consists of bank accounts. The trouble is, the people running the banks abused our trust. And the way they did it was that they weren't satisfied with mere deposits on the liabilities side of the balance sheet. No, they needed more. They needed to grow the balance sheet and keep growing it in order to generate sufficiently high returns on equity to remunerate themselves in the shares of their own banks, which is, of course, how they were compensated. Most people in Lehman Brothers were compensated with Lehman shares. Leverage, ladies and gentlemen, the key word of our times. The age of leverage was an age in which banks borrowed from one another ever larger sums, growing their balance sheets in relation to their capital until they reached this extraordinary state of affairs. This is average bank leverage measured as total assets, that's just all the loans, the loan side of the balance sheet, divided by shareholders' equity, the capital of the bank. You could do the same calculation with liabilities and it would be much the same. And this shows you, among other things, that American banks were not the worst behaved banks, because the average degree of leverage was not as high in the US as it was in, surprise, surprise, Germany. European banks were actually much more leveraged, still much more leveraged than American banks, which is one reason why complacent Europeans don't yet realize the crisis is going to be much worse here. The monetary crisis is actually more acute in Europe and harder to deal with. But the general rule is clear. What banks did in the pursuit of maximum profits was to become excessively leveraged. And when the liquidity crisis came, and it emanated, for reasons I'll say more about in a minute, from a rather obscure corner of the US mortgage market, when it came, the banks were caught, exposed. Their trust in one another evaporated with astonishing speed. And slowly our trust in them went too. Bank runs. Bank runs which could have exploded had it not been for the intervention of the authorities. So, point one, money is bank money. It depends on trust. It's a relationship. If the trust is gone in the banks, the monetary system is fundamentally broken. And that is 1/6 of the story that I'm going to tell you tonight. Part two, the rise of the bond market. That's a bond. That's a consol, to be precise. The Consolidated Fund transformed the way in which the British government was financed by turning the entire national debt of mid-18th century Britain into perpetual 5% bonds. It's one of the great innovations of financial history, and it put Britain in a position of profound financial strength relative to its principal rival, France. So the bond market was invented in its early form in Renaissance Italy, but reached its modern zenith in Hanoverian Britain. A part of the story we need to understand about financial history is therefore the transformation of the bond market, which began as an instrument for financing government debt, financing the imbalance between expenditure and revenue by selling people bonds, promises to pay interest on a specific capital sum for a specified period, including perpetuity. Consuls were essentially supposed to pay that 5% forever, though they could be redeemed if the price rose above par, that is to say, the face value of the bond. I tell the story in the book of the master of the bond market, Nathan Rothschild, who in many ways took the bond market to a new level of sophistication in the period of the late Napoleonic Wars and the early Restoration years. It was really Rothschild who internationalized the bond market, though it had been in some measure international before. It was Rothschild who made the great leap that if the British government could finance itself out of the savings of Londoners and some people in Amsterdam too, then any government could. It was Rothschild who brought Prussia to the London bond market, Russia to the London bond market, and then even Brazil, Portugal, Spain. The bond market in the 19th century was a crucial institution. How anybody can write about the 19th century without mentioning the bond market still defeats me. It's been 10 years since I published a history of the Rothschild Bank, and still mainstream historians of the period don't get it. 19th century governments had incredibly narrow tax bases. Every time they went to war, they had to raise money. They did it by going to the bond market. If the bond market didn't want to know, they were screwed. It explains a huge amount about mid-19th century history. I still marvel at the fact that so few of my colleagues in mainstream history see this. So we tell the story of the bond market. From Waterloo, after which Nathan made his biggest trade. It's a great story of how he put an enormous bet on the UK bond market in the aftermath of Napoleon's defeat, and it paid off in the most extraordinary way over a period of about 18 months. Well, we go from Waterloo to Newport Beach. That man, anybody recognize him? Sorry? Bill Gross. Only two people. So Bill Gross is probably the Nathan Rothschild of our time. He runs PIMCO, which is the single biggest bond management fund in the US, Pacific Investment Management Company. And Gross has been a critical player in this entire crisis. He anticipated it. He made a series of extremely shrewd bets on the way in which the crisis would unfold. But the key to understanding his role is that the bond market is no longer just a market for government bonds, for government debt. It has become a much more heterogeneous market, in which the bonds issued by corporations are traded, and also in which bonds created out of mortgages are traded. The transformation of the mortgage market into a part of the bond market is a crucial part of this story. The word is securitization. Securitization is when you take the mortgages of everybody in this room, bundle them together, get all the revenue streams pointing in one direction, and then slice and dice the revenue and sell it off as bonds. But don't call them bonds. Bonds are so prosaic. Call it something nicer and fancy. Call them, I know, collateralized debt obligations. Oh, that sounds great. CDOs, we can surely sell a lot of them. And I tell you what, let's take some really ropey mortgages, bundle them together, and then say that the top tier of the revenue from these mortgages is AAA rated. Well, who'll believe us? Well, we'll get the ratings agencies to say that they're AAA rated. Then everyone will believe us. The key to the history of the bond market in our time has been its transformation into a mechanism for securitizing and selling almost any kind of debt, including some distinctly dodgy kinds of debt. it's particularly interesting that the originators of mortgages were able, through securitization, to sell the revenue streams to investment banks, who then created the bonds, or CDOs, who then sold these on to, I don't know, municipalities in northern Norway, just south of the Arctic Circle. The story, I think, getting so vexed with this thing, I won't hit the button anymore, I'll just point it. The story of the mortgage securitization running amok is quite nicely summarized in this chart, which just gives you the proportions of mortgage debt outstanding in the US by holder. So you can see the increasing importance in the light green area of the federal and related agencies, the government-sponsored entities, including, notably, Fannie Mae and Freddie Mac. Hardly anybody I knew a year ago had heard of Fannie Mae. In fact, I had a constant battle with Channel 4 about whether they should be referred to in Film 2 or Film 5 of the series. In fact, it was deleted from the script at least 10 times and restored by me. These institutions became enormous engines of mortgage finance, issuing vast quantities of mortgage-backed securities, of bonds, underwriting them on the basis of a rather spurious implicit guarantee that as government-sponsored entities, they had the backing of the federal government. Could I have the next slide, please? Oh, go back a second. By comparison, you'll see at the bottom of the chart the decline of traditional savings institutions. Once upon a time, if you remember, in Frank Capra's It's a Wonderful Life, mortgage lending was done by things called savings and loans in the United States. These were building societies in this country. They were basically local. They took deposits from local people, and they made loans, mortgage loans to local people. And they knew both sides of the deal. The decline of those institutions, which in the US blew up spectacularly in the 1980s, is a critical part of the story. The end of that narrow and focused mediation between debtors and creditors. In a securitized market, no one can hear you scream. When they defaulted on the subprime mortgages in Memphis, Tennessee, the people in Norway managing the municipal finances had no idea what was going to hit them. But the toxic waste very quickly passed its way along that chain I've described to you, so that the losses in Memphis ended up in Norway. And that's a part of our story. Could I have the next slide? The third part of the story is the stock market. The stock market is a relatively recent invention. It didn't exist before around 1600. It was invented in Amsterdam. The first stocks traded were shares in the East India Company, the Dutch East India Company, and they were traded here in the Amsterdam Beurs, the stock exchange. Now, what is a stock exchange? It's a place where you buy pieces of the action, slices of the capital of corporations, joint stock corporations, which means something quite different from bonds. You're buying a much larger potential upside when you own a share of a company's equity. But there's also a higher probability you'll end up with nothing, since most companies do fail. And the East India Company was remarkably successful for a remarkably long time and made its shareholders relatively wealthy. The interesting thing about stock markets is that they essentially price expectations of the future profitability of corporations. That's what they do. The price of a share is essentially a statement about the future earnings, relative earnings, I should probably say, of all corporations that are represented in the market. And that gives us a clue as to why they're quite volatile. Why it could be that not long after the stock market was invented, 110 years or so after it, the first stock market bubble happened. The stock market bubble is an interesting phenomenon. It's not terribly common that it happens in bond markets. And that's because you can have much more optimistic visions of the future earnings of a corporation than you ever can have about the future returns on a bond. If you believe, this time it's different, that the Mississippi Company, created by John Law, a convicted Scottish murderer who pitched up in Paris with a gimcrack scheme to reform the French monarchy's finances, if you believe the Mississippi Company is going to make more money than any company in history because it controls a monopoly on trade with the Louisiana Territory, roughly about a third of the future United States, if you believe that, then the price of shares in that company can go through the roof. If you think it's cornucopia, you'll buy those shares at any price. The other critical point, then, is that somebody has to be ready to finance your purchase of those shares. Two things are necessary for a stock market bubble. One, expectations of enormous future profits. Two, a monetary authority ready to lend cheaply to investors. John Law had both. He simultaneously controlled the entire corporate sector of France and the equivalent of a central bank. In fact, he controlled the tax system too. He controlled the entire French economic and financial system. And he illustrates the point that no bubble is possible without a lax monetary authority. That's as true in 2000, 2001 as it was in 1920. The story of Enron is in many ways the story of the Mississippi Company told over. And it's not entirely coincidental that just months before the collapse of Enron in 2001, Alan Greenspan received the Enron Prize. That's Kenneth Lay, president of Enron, handing the prize to Mr. Greenspan for services rendered. It's inconceivable, ladies and gentlemen, that there could have been a dot-com bubble, a bubble that the Enron company was happy to ride aboard, without the policy of the Federal Reserve. So, two things to understand about stock markets. Human psychology, we can get terribly carried away with future earnings of corporations, particularly if we think this time it's different. If we think the fundamental shape of the world economy has changed, whether it's because of technology or the discovery of Louisiana, but you also need a central bank that's going to accommodate the speculation. In 2004, Alan Greenspan's successor, Ben Bernanke, gave a lecture he will live to regret giving. It was entitled The Great Moderation. And in it, Ben Bernanke claimed that the world economy had become a great deal less volatile, a great deal more stable. Indeed, recessions had all but receded from memory, thanks to the ingenuity of central bankers, who had greatly improved the way in which they handled monetary policy. How had they done this? By focusing closely on core inflation, by not worrying about any other signals, but the signals coming about inflation and inflation expectations. And this chart gives you the story of Fed policy, 1995 to the present, looking at the consumer price index, which was their main focus. The nemesis of the great moderation has come in our time. Because, of course, while they were focusing on core inflation, Greenspan and Bernanke were ignoring asset price inflation. It became an article of faith at the Fed that you didn't need to worry about that. That was Greenspan's position. It wasn't for Greenspan to worry about the dot-com bubble. Nor was it for Bernanke to worry about the real estate bubble. The business of central bankers was consumer price inflation, stripped of energy and housing costs to boot. Nemesis came because these bubbles should not have been ignored by the central bankers. And you can see here, if you just chart the annual fluctuations in the S&P 500 and the Case-Shiller Composite, which is an index of US house prices, they were going crazy. While the central bankers were focused on core inflation, asset prices were going nuts. First, stock prices, and then you can see it. You had property prices in the US accelerating, ultimately at a rate of 20% a year. The central bankers didn't notice. Or if they did, they said it wasn't their problem. Next slide. No account of the financial system can exclude insurance, but only a madman would write an entire chapter of a book about insurance, and an even madder man would make a television film 1 hour long about insurance. And yet it's absolutely fascinating. I'll tell you why. Insurance was invented even later than the stock market, proper insurance, based on pension funds and insurance funds against premature illness or premature death. This all dates from the 1740s, and it was invented in Edinburgh. You remember this? Do you remember the Scottish widow? That rather sexy bird in the velvet hood? It's actually Roger Moore's daughter. Well, the original first true insurance fund was the Scottish Minister's Widow's Pension Fund. that was set up to provide for the widows and orphans of dead clergymen in Scotland. Now, it's very smart to create a fund to provide against that kind of thing. It's smart because the risk of the death of a clergyman is remarkably easy to calculate. And you can also calculate roughly how long their widows and orphans will survive. That's because human lifespan is really quite predictable. Once you have a large enough group of people, the averages work out quite neatly. Life tables of the sort that had been developed in the 18th century made it possible for the founders of the Scottish Ministers' Widows Pension Fund to calculate with spectacular accuracy how much money they would need to take in contributions, how much they would then have to invest, what the return on the investment would need to be, what the payouts would be each year. They got it absolutely right. It was a great feat of mathematics, and they had a mathematician from Edinburgh University to help them with their calculations. But it also illustrates a critical point. You could insure against calculable risk. You could insure against all kinds of things that are distributed normally along a bell curve, with most of the incidents clustered around the mean. But it's a slightly different matter when you try and insure against other things. Yeah, you can even insure against natural disasters, though earthquakes are hard. They're not normally distributed. And it's interesting that it's very often earthquakes that blow up models of insurance of the sort that were devised in 18th century Scotland. It happened to the insurance industry in Japan at the time of the Tokyo 1923 earthquake. The costs were just too huge for the insurance system to cope with. And I argue in the fourth chapter that it's partly the need to cope with really big disasters that brings the welfare state into existence. It's a very, very different model for handling risk. Instead of paying in a contribution to a fund that will pay out in the eventuality of something going wrong, welfare states existed to cope with really big disasters that insurance couldn't cope with, like earthquakes and wars. These are the things that insurance can't cope with. And the reason we ended up with welfare states was as simple as that. Now, what I want to try and show you is that insuring against earthquakes is a little bit like insuring against financial crises. Because financial crises are not normally distributed, if you drew a curve of fluctuations of the stock market, it wouldn't look like a bell at all, because there'd be fat tails in the distribution. There'll be lots of big years up and big years down, many, many more than if financial outcomes were normally distributed. Bit like earthquakes, bit like wars. And yet we tried to insure against them. An entire segment of our financial system was designed to insure against financial earthquakes. Call it derivatives for short. Derivatives mystify people, they shouldn't. Mostly it's just insurance. And insurance against, for example, a decline in the stock market of 20% in a year. You can buy protection against that eventuality by buying a derivative. Options, calls, puts, the works. The whole system of derivatives is essentially a complex of insurance policies to cover people against unfortunate financial events. And here you can see the extent to which this peculiar form of insurance exploded in recent years. Here we have all the different amounts outstanding of over-the-counter derivatives just in the years 2000 to 2007. What we've seen, what we are seeing, is the danger of writing insurance policies in this kind of area. Selling options to pay out X amount in the event of a 20% decline in the stock market is great most years because it doesn't happen. But when it does happen, you've got to pay up. Selling credit default swaps that promise to compensate people when a firm goes bust and its bonds become worthless is good business most of the time. But when a massive financial crisis comes along and Lehman Brothers goes bankrupt, then if you wrote those credit default swaps, you've got to pay up. It was as if investment banks and insurance companies who sold this kind of protection imagined that the risks were distributed normally, like life expectancy, but they weren't. Financial risks are not like that. Financial risks are like earthquakes. When the big one comes along, it's way, way bigger than you expected. And it comes along way, way more frequently than you expect. As you can see, I'm putting together a jigsaw. The fifth piece of the jigsaw is real estate. It's worth remembering that for most of history, only a tiny number of people owned their own properties and had mortgages. The great innovation, and this is a nice illustration, Stowe House, one of the most spectacular private residences built in the 18th century in England, and mortgaged to the hilt, incidentally. The great innovation of the 20th century was the idea that most people should own their own homes and have mortgages. And I trace this innovation to the Depression in the 1930s. It was a great leap forward at the time of Franklin Roosevelt to encourage and ultimately achieve a majority of households to be homeowners, and to make the mortgage something that a majority of Americans could afford to have. The property-owning democracy, the POD, is one of the great 20th century conservative ideas, actually, even if it did emanate from the Democrats. The idea that if people own their own homes, they're somehow immune to political radicalism. The property-owning democracy made it here in the 1980s with Margaret Thatcher's effort to sell council houses to tenants. It's a wonderful insight. It makes a great deal of sense politically, but it's financially got its limits. And we discovered them. We discovered them last year. You can see here the rise of home ownership rates, particularly from the mid-1990s in the various different parts of the United States. This was government policy, aided and abetted by the financial services sector. Sell mortgages. Get people at the margin to become home owners. Get the ethnic minorities to become home owners. Don't worry too much about documentation. This is a political imperative. We want to increase the home ownership share. Time and again, Republicans and Democrats alike affirmed that this was part of, to quote Ronald Reagan, the American dream. And I argue in Chapter 5 that it's the incentivization of home ownership, it's the encouragement of households to take out large mortgages, which is absolutely the key to understanding the subprime crisis. Going to the marginal tenant and saying, become a homeowner. Here, just sign this, and we'll give you a Ninja. Ninja loan is a no income, no job, no assets loan. And there were a great many of those made in places like Memphis between around 2002 and 2007. So a critical part of the argument, I'll have the next slide please, is understanding why we've got this obsession with property. Why it is that people, especially in the English-speaking world, have an obsessive desire to borrow money to buy houses. And the shattering of this illusion, here and in the United States, is a critical part of this crisis. Because it doesn't make any financial sense. I don't care about the politics. It makes no financial sense to incentivize everybody to take a one-way, unhedged bet, highly leveraged, on a single asset. Because that's what we do. It's what we almost all do. It's nuts. And it only makes sense if that asset never goes down in price. But it does go down in price. Those who believe that property prices could only go up didn't know enough financial history. They declined dramatically in the early 1930s, and of course they declined quite dramatically in the early 1990s in this country. They fell off a cliff in Japan in 1989-90. Where did we come to believe that there was only an upside to real estate? I've got one last point to make, and then I'm going to draw to a close. You can't understand this crisis if you don't see in its global framework. It's the fact that the institutions I've described to you spread throughout the world and became global that is the key to understanding the phenomenon of chimerica. You really only need to understand this one thing to understand the global economy today, the relationship between China and America. Call it chimerica for short. You can trace it from Hong Kong to Chongqing, spectacular place I visited while we were filming the series. And here's how the relationship works. My finger works much better, doesn't it? Chimerica was a bit like my marriage. One partner did the saving and the other did the spending. You have the same problem, do you, gentlemen? Spectacular growth in the savings rate in China, collapse of the savings rate in the United States. That's really the story of chimerica. One half does the saving, the other half does the spending. And without that, without what Ben Bernanke called the Asian savings glut, I don't think the age of leverage would have been possible. Without Asian and Middle Eastern savings, you couldn't have had a 6% of GDP current account deficit in the United States, and you couldn't have financed it at such low rates. With 10-year treasuries yielding less than 4% throughout the Bush era, it was possible to put on ever more debt. Households did it, and as I said at the beginning, banks did it. Call it the age of leverage. That's what we've lived through, and folks, it's over. By the way, if you look at that chart, you'll see something rather chilling. UK households are far more leveraged than US households. That simply gives you household debts as a percentage of disposable income. And you can see the extraordinary upward run that we've had in the last decade. Ladies and gentlemen, this story has its villains and its heroes. There's John Law, that Scottish villain. There's a Scottish hero, the Alexander Webster, one of the founders of the Scottish Widows' Pension Fund. The book features the rich, needless to say. George Soros plays a leading role, but it also features the poor. You can't really understand the failures of 19th century insurance without going to the workhouse and seeing what being uninsured meant in the Victorian era. It's a book and a series that describes dreams. This is what Louisiana was supposed to be. If you invested in the Mississippi Company, you were investing in that vision, cornucopia. But it's also a series, it's also a book about delusions and disillusionments. I love these Dutch plates that were produced after the collapse of the Mississippi bubble. The one at the top says, "By God, all my stock's worthless." And the one down below is, "Shit, shares and wind trade." There's a huge number of these, actually. We saw them in Amsterdam. They're quite wonderful. It's a series that also looks at why, in crises, the backlash against finance often takes on the form of anti-Semitism. This cartoon of Rothschild from 1898 is rather typical of the phenomenon. And here are the key themes. 1. To recap. Money isn't metal. It isn't paper. It's a relationship based on trust. And it exists to broker the relationship between creditors and debtors. 2. The bond market can still terrify any government. Barack Obama, please take note. 3. Stock markets are essentially mirrors of human psychology. The fact that we can go from euphoria to depression and from greed to fear in a day is the key to bubbles and busts. 4. You can insure against risk, but you can't insure against uncertainty. And that's a fundamental mistake that's been made again and again. 5, the property-owning democracy skews virtually everybody's financial strategy in the English-speaking world in favor of that one-way, unhedged bet on a single, pretty illiquid asset. 6, the future of planet finance, the future of this system I've described to you, depends fundamentally on Chimerica, the relationship between China and America. And with that, I think it's time for me to shut up. Thank you very much.